Introduction. Stock market is the place where both the buyer and seller of stocks meet under one umbrella. This is the place where trading is done. In fact, this is the dream destination for the people who want to earn a whopping amount in a short time. However, you cannot expect profits all the time in this market. There are high chances of losing your hard-earned money if you do not take the right decision in trading. It is imperative for the traders to have a profound knowledge on the stock market and its theories to carry out trading successfully. The traders who want to earn money should live and breathe stock market theories. Ideally, the stock market is the place where the seller sells the company's stock and the buyer buys them for the market rate. It is alike to that of fish and cattle market. Basically, stock is the share in the company. The person who owns 50% of the share in the company, then he owns the company and the company runs on his or her directions. There are many components that you find in a stock market. There include stock exchange, stock market brokerage, stock market traders, and stock market indexes. The stock exchange is the company which runs the stock market smoothly. These people display all the shares of different companies and prices of each share. In addition, these stock exchanges help both buyers and sellers to exchange their shares electronically in an ethical manner. Examples of the stock exchanges that are always in the news include London Stock Exchange and New York Stock Exchange. The companies are important for the stock market to work efficiently. Moreover, the public limited companies are listed in the stock market. The people who want to invest in these companies have to buy shares through the stock exchange, and the company is only listed in the public limited companies if and only if they meet the set financial requirements. Stock brokerages are the brokers who act as a middleman between the stock exchange and the buyers. They have a clear-cut idea of the stock market and the prices of the stocks. These people are the one who can help out both the buyers and sellers to reap profits in the stock market business. These brokers will get to know the selling and purchasing price of stocks from the stock exchange, and they sell them to the buyers. It is vital for the brokers to be legally registered to buy and sell stocks. The stock market is dead without buyers and sellers. The buyers are the affluent people who are looking to invest in the companies, whereas sellers are the one who already holds a share in the company and are planning to sell them for the best market price. Few of the popular stock market indexes include S&P 500, the Dow Jones 30, and FTSE 100. These are the indicators of stock. For instance, take S&P 500. This indicates the stocks of top 500 US companies. In case if many of these public limited companies are selling their stocks, then the indexes will be slumped down. In this ebook, we will discuss about how the stock market works, different types of stock market theories, and market indices. These concepts will help both the amateur and professional investors to gain extensive knowledge on the stock market. Chapter 1. How stock market works. The stock market is the place where both the buyers and sellers participate in the trade. The public companies who want to sell their stocks to raise an investment in expanding the company will put their shares on the stock exchange. In order to trade, the investors have to first create an account with a brokerage firm, which actually will act as an agent. This broker is the one who acts as an intermediary between stock exchange and the investor. The stock price totally relies on the supply and demand. In case if the buyers for a particular stock is higher than the sellers who are willing to sell their stocks, then the stock prices would be high, and if the buyers are less and sellers of the stocks are more, then the stock prices would be lower. As per the stock market theory, the price of the stocks should be determined by the company's profits. However, in the practicality, the price of the stocks is determined based on what the investors would get in return from the company in the near future. The investor like to buy the stocks at a low price and would like to sell them when the prices of the stocks go high at an attractive amount. Many investors assume falsely that the stock price will go up for a short period and would slump down after a few days. With this misconception, they sell the stocks when the price of the stock is a little higher than their purchased price. Difference between stock market and stock exchange. The stock market will list out all the public companies on the stock exchange to allow the public investors to buy or sell their shares. Stock exchanges are the one that allows both the sellers and buyers to trade their stocks and securities at one place. Without a stock exchange, there would be no place for the companies to list their shares, and without stock market, there would be no life for the stock exchange. Both stock market and stock exchange go hand in hand. You can either manually buy the stock or electronically transfer the stock from the seller name to your name. These stock exchanges give information about the stocks of various companies clearly. Synopsis. In the United States, all the public limited companies will list out their stocks on the New York Stock Exchange or other stock exchanges. These exchanges provide a transparent way to trade for both buyers and sellers. Moreover, companies sometimes list their shares on the less regulated stock markets to get price transparency. Volume of trades. The buyer and seller of the stocks can gain profound knowledge about the stock market by going through the information collected on the stock exchanges. In these stock exchanges, the participants can view the number of stocks being listed by a particular public limited company, number of people showed interest in buying the stocks, and the conviction level that investors have shown in buying and selling those shares. In addition, the stock exchanges generate the statistics of the stock market volume of each company as per the shares that are being sold and bought by the sellers and buyers. Price. The stock exchanges ensure that the prices of the stocks listed on the stock exchanges are as per the market value. These stock exchanges also have the highest amount that the buyer is ready to pay for the stock and the price that is being tagged by the seller. The stock markets are able to run successfully without any kind of concerns because of stringent and transparent stock exchange procedures. These procedures are developed to slump down the trading expenses and provide transparency of the stock prices. Clear standards. It is imperative for the public limited companies to meet the financial requirements to list their shares of the stock exchanges. However, the standards vary from one exchange to another. Basically, every stock exchange will check the company's size, the revenue stream of the company, and other factors before adding them to the list. Ideally, the stock value should only fall down in between $1 to $3 value per share. In case, if the company's share value slumps down to the lowest value for a long period of time, then the company will be pulled off from the stock exchange list as per the U.S. Securities and Exchange Commission. Chapter 2. Why people invest in the stock market. The stock market has a huge demand since ages, and this is considered to be an ideal place to invest money and earn an astronomical amount in a short time span. Though it is highly risky to invest in the stock market, but at the end you can either end up earning a huge amount or pushed into heavy losses. However, the professional investors have earned a whopping amount in the stock market and became billionaires, and people who have the ability to keep the risks at bay could maintain their financial position healthy and earn an attractive amount. Here are a few reasons of why people are exhibiting interest in investing in the stock markets. Get huge returns on the investment. One of the key reasons for investing in the stock market is to earn money over time. At some point in the year, the stock value would become pretty high despite of rising and falling of a day. Basically, by investing the amount in the companies that are growing at a faster pace will help you reap huge profits than expected. Moreover, people who have profound knowledge about the stock market can invest in diverse sectors to grow money. Though the stock value of one sector slumps down, you can earn a huge profit from the stocks invested in other sectors. Get dividend income. Few of the stocks calculate the income in dividend form. Basically, the stocks that offer dividend will help the investor earn some amount of money at the end of the fiscal year. Though the stocks are ending up with a loss, but the profit that the investor can reap is calculated by selling the stock. Basically, dividend income will contribute to the retirement of the investor, or they can use this amount to invest in other stocks and grow their wealth over time. Diversification. The stock market reaps a huge profit for the investors who invest in diverse products. The best part of diversification is that though you incur huge losses in one investment product, you can reap profits from another one. This avoids the investors to risk their investment. Hold ownership rights. Basically, buying a share in the company means that you own a part of the company. You get that ownership authority when you buy shares. To be precise, it helps the investors to become a business partner in a company by owning shares. As a shareholder, you have all rights to take informed business decisions. Moreover, you would receive each and every information about the company and annual reports. Most importantly, having a stock in the company that you have been working would be the best way to show your loyalty to the company by striving your best to help the company attain more and more profits for yourself and for the company as a whole. Chapter 3. Various factors theory that have a great impact on the stock market. Below are a few factors that have a major impact on the stock market. Political. This is one of the key factors that one has to keep in mind while selecting the stock exchange where you are planning to invest your hard-earned money. Examples of a few stock exchanges include New York Stock Exchange, London Stock Exchange, etc. However, you need to take various factors such as political issues, current situation of the country, the government policies and their plans to improve infrastructure. And if you are planning to invest in the stock exchange of the country that is politically stable, then you can reap good profits. Political factors include security threats to the country, tax policies, trade restrictions, and friendly laws. Sentimental. You should be ready to take risks when you are investing in stocks. If you do not want to take risks but want to attain good profits, then you need to invest in the companies that are technically and financially sound, and if you are ready to take risks, then you need to invest for a short term, i.e. daily and weekly trades. Basically, sentimental factor means the risk that an investor is ready to take. This factor totally ignores the stock price that goes up or down with supply and demand. Here, the stocks go up with greed and down with fear. So the stock prices will move up and down not only based on the increase or decrease in supply and demand, but also based on the greed and fear. Economic conditions. This factor either has a positive or negative impact on the stock market. Various economic factors that have an impact on stocks include GDP rate, inflation rate, interest rate and exchange rate. For instance, if the banks in any country increase their interest rate, then it takes a toll on the stock market. Also, if the country's economy increases over other nations, then it generates more sales and the company's revenue is also increased. This creates a positive impact on the stock market. For example, if there is any natural disaster took place in the country and all the houses got demolished, then the cement and other construction material prices go up. This will have a positive impact on the cement industry of that particular country. One can be a successful trader in the stock market by anticipating the market conditions. This actually helps the investors to take the right decisions and grow money without losing any. Most importantly, the investors should be able to predict the market as a whole and its components thoroughly. However, there is no standard way to predict the stock market conditions. So even today, the stock market depends on theories. However, by thoroughly perceiving the stock market theories, the investors can understand about the stock market clearly and make informed decision of investing in the right stock. Understand about the company. The theory states that one can make the decision of investing in the stock market by understanding about the company clearly. Though there is no standard set of laws that state this, but as per the stock market theory, the companies that have stable financial position and is carrying out the business operation successfully are worth investing. This actually ensures that your investment is in the safe hands and helps you earn a huge profit. However, you cannot directly get the stock price, but the profits indirectly determine for how much amount you can sell the stocks to the buyers. Undeniably, the company that is not reputed in the market can also have a high stock price if the company is performing well. Moreover, the company that has a good fame in the market having a low stock price can boost the value of their stock if the public starts to invest in their stock. The more the people show interest in investing in a particular stock, the higher would be the value of the stock. Check the environmental factors. This kind of investment theory does not spend their valuable time in understanding the investment characteristics, instead will check the climate. To be precise, the investor will look at the economic and political factors and their impacts on the stock they are planning to invest in. This kind of investment theory will check various factors such as the new government that came into power and its impact on their investment and investing in the company that has expanded its operations in other parts of the world. The investor who is planning to invest will need to pay close attention to the details of how their investment is going to affect if the company in which they are planning to invest opens their business overseas, and how the economy of the business affects due to elections and war in that particular country. Supply and demand. This kind of theory totally relies on the supply and demand of the stocks in the stock market. As per this theory, the company stocks do not have any kind of impact on how the company is performing and political factors. It all relies on the supply and demand interaction. Sometimes the stocks would be less than the investors or more than investors. If the supply is more than demand, then the stock value would be less, and if the supply is less than demand, then the stock value would go high. Interest of the investors. This theory does not help you to anticipate the market conditions. However, the market does not behave in the way as predicted by the experts. By keeping this in mind, the investors will behave with the mob mentality. Few investors will invest in the stocks by following the other investors, and the stock market will go up or slump down by giving a little prediction, but not because others are buying and selling their stocks. Chapter 5. Different kinds of stock trading theories. In today's era, people are flooded with lots of information on stock markets and with too many opportunities. This is actually confusing the people on which option to choose and which is the right option to invest in. There are certain things that are viable only in a few contexts, and also you need to find what you want to achieve. This will help you find out the right options that suits your needs. The same thing applies for investment too. There are two different stock market theories available. We will discuss about those theories in detail. The theories include Elliott wave theory and Dow theory. However, each theory has its unique approach. The Charles Dow theory. This is the most complicated and elusive theory that is hard to understand even for the people who have extensive knowledge on the stock market. This theory was defined by the founder of Dow Jones Company, Charles Dow. The worst part is that both Charles Dow and his disciples have failed to explain the theory accurately. As per this theory, it states that there always some or other primary movement takes place in the market conditions alike to that of tidal actions and secondary movement like waves. Moreover, like the ripples that you can observe on the surface ocean, the market price movements keeps on fluctuating every day. The Dow Theory explains that it is quite easy for them to find the primary and second market movements by comparing the Dow Jones averages. In case, if the market moves in the same directions, either rising or falling, then it is predicted that the market conditions will change their directions. Dow theorists say that they are able to predict the market movements by embracing some vague formula for years. The analysts who have gained profound knowledge on the market disagree with the Dow theory. However, even today, many of the financial editors and market analysts are predicting the market condition based on the Dow terms. However, here are a few beliefs of Charles Dow. There are three trends in the market. Basically, the market moves in one direction, and after a few days it moves in another direction, and again comes back to the original direction. Market has three different phases. The expert investors will buy the stocks in the public limited companies, then they follow the market and sell the shares for the best price. Stock market is proactive. The stock prices would suddenly rise or plummet based on the economic and political factors. So when there is any positive or negative impact on the country, then it directly affects the stock price. Elliott wave theory. This is the derived and is the advanced version of Dow theory. This kind of theory best applies to all kinds of assets, goods, such as oil shares, gold, etc., and liabilities. This theory was founded by Ralph Nelson Elliott, an accountant and a business expert in the year 1938, based on the wave principle. During his retirement period, he started to educate himself on the stock market and started observing the market behavior every day. Moreover, he used to keenly view the charts to predict the market conditions. After studying about the market thoroughly, he finally concluded that the market behavior depends on the mob of investors' psychology. This person has explained the market behavior by using waves. According to him, the market has two major phases. One is a bull market and the other is a bear market. In the bull phase market, the prices go up in 5 waves. Out of 5 waves, three are in the upward directions, which are also called as impulsive waves, and the other 2 waves are in downward directions, which are called as the corrective waves. From the below wave diagram, it is clear that the first and second impulse has a minuscule correction, whereas the 5th wave is a little larger. So the downward wave has corrected the 5th wave, impulse wave, and the entire sequence. Basically, in a bull market, people can notice 3 waves in the upward directions and 2 in the downward direction. So once the 5 waves are completed, then people get the bigger the correction over the prior corrections. This correction will correct the 5th wave and the entire waves. Basically, each wave is made of 5-wave sequence, whereas each corrective wave is made of 3-wave sequence. Here are 3 thumb rules of this theory. Wave 2 never exceeds wave 1. Wave 3 would be the highest impulse wave. Wave 4 and wave 1 are never overlapped. In addition to the rules, the founder of this rule also discussed the wave personality at different positions in the wave cycle. The 3rd wave is the highest wave that indicates an increase in volume. The 4th wave, also called as corrective wave, is highly complicated. You would see sudden changes in the market behavior. When you feel that the correction in the 4th wave is fixed, then you would be thrown with another correction with a new complexity level. Moreover, the Elliott waves are simple and convoluted and long and short. For example, if you see wave 2, it is easy to correct, whereas wave 4 is a bit complicated to correct. These are a small clue that gives a clear-cut idea to the investor about the real-time stock market. Fibonacci Ratios. The Elliott wave theory can only be understood completely with Fibonacci ratios. Without explaining about these ratios, the theory would be incomplete. Basically, these ratios are derived from Fibonacci numbers such as 1, 1, 2, 3, 8, 13, and so on. When you start to observe the numbers carefully, each number is the total of the two preceding numbers. Examples of ratios in this theory include 38.2%, 50%, 61.8%, 100%, 138.2%, and 161.8%. Here are the characteristics of each wave that explains about Fibonacci ratios. Wave 2 corrects Wave 1 by 50 to 100%. Wave 3 is 161.8% of Wave 1. Wave 4 is 38.2% of the third wave. So when there is any correction in Wave 1, then it has a great impact on Wave 4, i.e. Wave 4 will be dropped 50% of Wave 3 and sometimes 60.8% of Wave 3. Wave 5 is calculated by taking 38.2% or 61.8% of the distance travelled from Wave 1 to Wave 3. In case if Wave 3 is extended a little more, then Wave 5 would be equal to Wave 1. Catastrophe stock market theory. If you are a person who has stopped investing in the stock market long ago but wants to resume investing in it again, then you need to assimilate the fact that it is not as easy as it was before. This is like to that of a boat that was sailing smoothly in the river and taking a jump over a waterfall. Stocks can rise or fall suddenly, so it is important for the investors to gain extensive knowledge on catastrophe stock market theory. This theory clearly explains about the sudden changes in the stock value. This theory was founded by a great mathematician, René Thom, using topology concept. He strongly says that this concept would help the traders and investors to identify whenever a drastic or sudden changes transpire. This theory helping investors identify the market disasters and surprises gained a lot of heat from the experts in the stock market. This kind of theory is applied when there is a recession or economic plummet. In the year 1974, Christopher Seaman has tried to enforce this theory in the stock market to find out the market crashes and bubbles. This theory was mapped by taking the investors who sold the stocks based on the asset value and the person who bought the stocks based on the market condition going up or down. After considering these two group people, he found that the interaction between them has resulted in the change in the stock price. So when the investor buys the asset or stock based on the market value, then the price would gradually change. According to the trendy investors, when the stock price goes high, then many investors would exhibit interest in buying the stocks, thus resulting in piling up of the investors. This can be compared to a bubble where all the investors show interest in buying the stock and after realizing that the stock is of no use and start selling them, thus bursting the bubble. This theory was being rejected by the experts a few decades ago, believing this theory as irrational. However, Thom has argued that this theory is used to bring the deep-rooted realities into light. Today, this theory is used by many financial analysts to predict the price drop beforehand and sell the stocks at an attractive price. Chapter 6. Stock Market Theory, Market Gauges and Indices. Market gauges will help you in understanding about the stock market condition clearly. The market indices are the stocks of the top public limited companies that are listed on the stock exchanges. They include S&P 500, Nikkei 225, and FTSE 100. These are the commonly used market gauges. The other rarely used market gauge is the Advanced Decline Line, which was derived by Stan Weinstein. This actually gives the total number of issues that are faced on that particular day and the number of them got resolved. Generally, the advanced decline line can be compared with S&P 500 since 75% of the US stock market is covered in this market indicator, and this helps you get the accurate market health. Stock market indices. Many people have a question of what is stock market indices. The simple answer would be stock market indices are nothing but a way embraced by the marketers to measure the condition of a particular section of the stock market. These market indices are widely used by the financial firms to measure the performance of mutual funds. Ideally, the stock market index has all the companies that are listed on the stock exchange from across the globe. Examples of market indices includes S&P Global 100 and MSCI World. Basically, the natural index will give the performance of the stock market of the selected nation. The national indices have the stocks of the public limited companies listed on the stock exchanges such as S&P 500, Nikkei 225 and FTSE 100. The Dow Jones Total Stock Market Index has the stocks of all the public limited companies in the United States, including the stocks that are listed on the New York Stock Exchange, American Stock Exchange, and Nasdaq. There are few stock market indices that give the performance of the stocks in particular sectors. Various market indices include Dow Jones Industrial Average Index. Ideally, 2/3 of the companies that are listed in this index manufactures industrial as well as the consumer products, and the other companies provide entertainment, technology and financial services. However, DJIA gives a clear picture of the stock market to the investors. When Charles Dow declared the first stock average a few decades ago, the stock market was not acquainted by many people. Today, stocks are considered to be the best investment area by the investors. Moreover, today the investors in the stock market are in millions, and most of them are salaried class people. These people are investing in stocks as this is helping them to build their wealth for their child's bright future. Few are investing in stocks to pay the child's education fee, and few are investing as part of their retirement plan. By doing so, people do not need to make debts or depend on others in the future. Moreover, there are many investment firms available in the market who are actually leading their hands to the investors to invest in the right place that helps them reap profits. One of the indices that played a major role in bringing a sea change in the stock market is the Dow Jones Industrial Average. A few decades ago, it used to be challenging for the people to understand whether their stocks are rising or plummeting. To help people who are bemused, Charles Dow has derived a stock average. He actually used sticks in the beach to determine whether the tides are coming in or going away. In case if the troughs of waves are higher, the bull market was succeeded, and if the troughs of waves are dropped, then beat market was prevailed. The stock's average has helped the individual stockholder to determine the stock value. However, it is fact that the stock value has a greater impact on the economic factors. Earlier, the average of the stock market was published vaguely, but over time they started publishing the precise value. In 1916, financial experts used to average for 20 stocks, and later the number of stocks have increased to 30, and in the year 1928, people started to calculate the average using special divisor instead of the total number of stocks. This helped the companies to get the accurate value despite of the company's shares are divided, or one stock is substituted with another. Today, this Dow Jones started providing the average of the entire US stock market. Also, at any point in the trading day, the Dow Jones Industrial Average is totally based on the transactions that had happened recently. S&P 500 Index. This is widely used index to gauge the US equities market. This index value was being first published in the year 1957. This index has huge assets. Moreover, over 500 top US public limited companies in diverse industries are listed in this stock exchange and covering 75% of US equities. The S&P indices can be used to prepare a portfolio. This S&P 500 is being maintained by the expert economists and index analysts. This indicates the US equities regularly. Moreover, the expert economists also keep a tab on the constituent liquidity to assure efficient trading besides keeping the index turnover low. The index committee follows stringent rules and provide guidelines to maintain the index. Moreover, there are a set criteria that a company has to meet to get added into the index. Index addition criteria. Factors that determine index addition include company's location, size, accounting standards, and exchange listings. Companies that have over $3 billion turnover. However, this turnover is reviewed regularly to ensure that it is not reduced by the change in the market behavior. There should be at least 50% of public stocks. Companies should have huge profits over 4 quarters. Ratio of the annual dollar value to the market capitalization should be greater than 0.3. Holding companies, royalty trusts, and partnerships are not eligible to add. Index removal criteria. Companies that breach the criteria is revoked. Companies that have filed for Chapter 11 and acquired by others are removed. Nasdaq Composite Index. This kind of index measures both the national and international stocks that are listed on the Nasdaq. This stock exchange has 3,000 companies. This market index is majorly followed by the investors. The companies are only included in this stock exchange only when they meet the Nasdaq criteria. FTSE 100 Index. This FTSE 100 index is also called as FTSE 100 or FTSE. On this stock exchange, over 100 top companies of UK are listed. This stock exchange is maintained by the FTSE Group, that is a joint venture between London Stock Exchange and Financial Times. These people calculate the stock value in a couple of seconds and display them for the investors. The investors checking the stock value either buy or sell their stocks. This 100 companies that are listed on this stock exchange has 81% of the market capitalization of the entire London Stock Exchange. This is widely used stock indicators by the investors. However, there are other indices available in London, and there include FTSE 200 Index, which has 200 companies on the stock exchange, the FTSE 350 Index, FTSE Fledgling Index, and FTSE Small Cap Index. The index constituents are calculated for every quarter. Moreover, if the market capitalization of FTSE 250 companies has increased, then they would be placed on the list of top firms in FTSE 100. However, the companies that meet the criteria and tests, liquidity, free float and nationality, set by the London Stock Exchange can only be placed on the stock exchange. Nikkei 225 Index. This displays the stock index on the Tokyo Stock Exchange, TSE. This stock index is calculated by the reputed newspaper in Japan. This is alike to that of Dow Jones Industrial Average. This displays the average of Japanese equities. These people update the indexes after every few seconds. This index gives the value of the entire market instead of one particular sector. The stocks listed on this stock exchange are reviewed in the month of September, and the changes to the stocks are made in October. Moreover, the stocks that do not meet the criteria are removed from the list.